about positioning in an uncertain market. And Colin, I guess the idea of being conservative, you hear it all the time, but what does that really mean?
A few things. I mean, I think you can look at it on a sector and a business level, John. So we think about sectors that are perhaps non-cyclical. I mean, I don't think any sector is completely non-cyclical, but ones that maybe aren't going to go up and down with the economy as much, where the demand is pretty resilient. And then I think you can look at the business level and think about the characteristics of that particular business. Very steady, predictable cash flow would be something we look for. A dividend that's been paid consistently over a long period of time. So I think those are the types of characteristics that we look for in a steady business. And as I was saying earlier, I think in this environment with economic uncertainty, policy uncertainty, trying to find businesses that maybe are, sold off for some unwarranted reason, but have a lot of those predictable characteristics are ones that, that's kind of what we're looking for right now.
And sometimes in an environment like this, people start talking about these terms like value versus growth. We did see growth find a big bid in the market yesterday. And so I do wonder if the appetite for those stocks is completely void. I would say it's not. And maybe that's because those companies have shown an ability to grow in an uncertain world over the longer term. But can you have growth without necessarily having as much volatility as some of the biggest technology companies have had?
Well, for sure. I mean, I think there are a lot of businesses that are maybe not technology companies or not healthcare companies or biotech that are growing, and they've been around for a long time. They're steady. They're growing because there's good demand for their products. And some of those, what we love to see is a company that's growing nicely, but, that we think trades at a value multiple. Those are the best situations. I mean, we don't sort of look for, I would say over the last 10 years, growth has massively outperformed value. So we think from a factor or style perspective, value is likely, particularly in this environment, a place for investors to focus on. But if you can find a company trading at a reasonable multiple that's growing nicely, that's I think the ideal situation.
Okay, one stock example you wanted to highlight, if you're looking for a little bit more of a conservative nature in your portfolio, is Jamieson Wellness. This is the vitamin maker. It's become a global business. What stands out with Jamieson?
Yeah, I mean, number one, it's just a great business. They've got the strongest vitamin brand, leading market share in Canada. I mean, anyone that goes into a grocery store or Shoppers Drug Mart or anything in Canada will see Jamieson's products, prominently featured on the shelves. And, I think they're a trusted Canadian brand from that perspective. As you suggested, the business globally is growing, particularly in the U.S. They made an acquisition of a company called U Theory out of California a couple of years ago. So they really have low market share there, but that business is growing quite nicely. And they also have a big presence in China, where they've had for a while, but they've been expanding that business through a partnership with a private equity firm there. And they've been, putting up very, very strong revenue growth in China. So we think this brand is going to continue to grow globally. And interestingly, the share price is down about 20% this year, and we think that's unwarranted. There are perhaps some fears around tariffs, which we don't think, again, are warranted. Only about 8 or 9% of their business, in our view, it could really be impacted by tariffs, and there are mitigants to that as well. So it's a company that's not that impacted because the vitamins they sell in the U.S. are largely manufactured there. There is not a lot of cross-border flow, and again, it's a non-cyclical, recession-resistant business, and it's now trading at what we would almost say, for at least for a company like this, is a value multiple, about 10 times EBITDA and 15 times earnings.
Real quickly before we take a break, I'm glad you brought up how these companies operate within specific countries, because when we spoke to Jamieson's CEO, Mike Pilato, recently, he made that point, that if there's cross-border tariffs, keep in mind that they have operations in the U.S. that can serve the U.S. market and operations in Canada that can serve the Canadian market. Is that easy to figure out in financial statements with businesses, or do you just have to, as an investor, be curious, maybe ask the company?
Yeah, it's not always evident exactly in the financial statements. I think it just comes with knowing the business, meeting the management team over time, getting to know them. And, particularly now, as we know, a lot of Canadian companies are going out of their way to point this out and where they have exposure and if they have manufacturing in the U.S. and Canada. And companies like the auto parts companies, for example, we know are shipping things across the border a lot. But a business like Jamieson, as Mike obviously pointed out, is they have a big manufacturing base and a lot of people in the U.S. producing that product.
Okay. Colin, we're going to take a quick break, but we're going to come back with Colin Stewart, because another big theme in Canada right now is